Welcome back again to another on our series of macroeconomic lectures. This particular lecture is a follow-up to the introductory lectures we had on monetary policy, and in the previous lecture we discussed the money market. We talked about the transaction demand for money and the asset demand for money, which made up the total demand for money. And then we had the supply of money, which is managed by our nation's central bank called the Federal Reserve. In this particular slide, we're going to be talking about interest rates and bond prices and why there's an inverse relationship between interest rates and the price of bonds. So first, just some basics about a bond. I, the best way to talk about bonds is to talk about the most generic or routine bond that they're traded. And we could call these the 10-year Treasury bond, right? That's the most widely traded bond. So these are bonds that the U.S. government, uh, the federal government, not the Federal Reserve, right, has issued to borrow money. So our federal government finances the debt or the deficit by borrowing money, and they do this by using 1 year, 2 year, 5 year, 7 year, 10 year, and 30 year treasuries. So let's just talk about the 10-year treasury. It's the easiest one to understand. If you bought a 10-year treasury bond, let's assume that the coupon rate or the interest rate on that bond was 3%. What happens is that if you bought it, say, in 2005, you would own that bond for 10 years, and every year for the next 10 years you would get a check for 3% of 1,000, because bonds are sold in $1,000 increments. So if you bought one bond, you'd get a check for $30, and at the end of 10 years you get your $1,000 back. So you let the federal government borrow $1,000 for 10 years, and you're rewarded. The reason why you would do this is that you're paid interest. That's the reason people buy bonds, is that you know, there's interest paid to the bondholder. Right. So why is there an inverse relationship between the bond prices and interest rates? Well, assume for a minute that you bought that 10-year Treasury bond on January 1st of 2005, and it was yielding 3%. That was the interest rate, right? Well, assume the next year that interest rates went up to 4%. Right? Now, obviously, if you wanted to sell your bond, no one's going to buy your bond from you for $1,000, because they could easily buy a new bond that yields 4%. Right. So therefore, when the interest rate went up, the value of the price of your bond went down. Right. Now, of course, if you bought a 10-year Treasury bond on January 1st of 2005, and the following year interest rates went down, then the value of the price of your bond would go up, because it would be difficult to find a new bond that was yielding an interest rate as high as the bond you had. So just some basics about bonds before we start talking about the Federal Reserve buying and selling these bonds, called open market operations. Right. So before we get into the tools of monetary policy, we have to look at the Fed's balance sheet. Right. So again, the basic equation here of accounting is that assets equal liabilities plus owner's equity. So what are the assets of the Federal Reserve? The assets of the Federal Reserve are securities, right? And so these are government bonds. When you hear that term securities, so when we talk about the Fed buying and selling securities, that refers to the Federal Reserve buying and selling government bonds, right? And we're going to look at the actual balance sheet of the Federal Reserve in both 2008 and 2010, and see how the balance sheet has expanded quite enormously because of the financial crisis. Right? The other assets that the Fed owns is that when the Fed makes a loan to a commercial bank, and that money's owed back to the Fed by the banks, that's an asset to the Federal Reserve. Right? So those are Federal Reserve Bank's assets. What about its liabilities? Right? Well, remember that all banks must deposit 10% of whatever checking deposits they have on reserve with the Fed. So if a bank has $1 billion worth of deposits at its institution, 10% of those, 10% of that number, so that'd be 10% of a billion is 100 million. That bank would have to have $100 million on reserve with the Fed. Now remember, that's the bank's money. In other words, so the Fed uses the required reserve to affect lending, right? But in essence, that's a liability to the Federal Reserve because those funds are owed, those reserves are owed back to banks. Right? And then Treasury deposits. Now remember we said that the Federal Reserve is the fiscal agent for the federal government. In other words, Uncle Sam has a bank account with the Federal Reserve that they draw checks on. Right? And then finally, the other last liability is federal notes outstanding, which is simply cash in circulation. Right? So assets of the Federal Reserve, government bonds, also known as securities, and the loans that banks have borrowed from the Fed, that's an asset to the Federal Reserve. Liabilities are the reserves of commercial banks, treasury deposits, and paper in circulation. So let's look at some actual numbers here. In 2008, right? Now this is in millions of dollars. So this is Valentine's Day of 2008. Right? You can see that at that point, the Federal Reserve owned about 714 million, right? In that's that's a very large number when you talk about the securities that they owned. And if you look, that's almost closely related to the federal notes outstanding on the liability side of the equation. Right? So if you look at the totals down bottom here, you have basically 885 for assets and liabilities and net worth. That equals out. But let's look on the next slide. In this particular slide, we have the Federal Reserve's balance sheet just 2 years later, right? So 2010. So you can notice that the balance sheet of the Federal Reserve expanded quite enormously in a 2-year period. And this is because of all the work the Federal Reserve, our nation's central bank, has done to try to bail out, to try to rescue the economy. So the Federal Reserve bought all kinds of securities, bonds that where it was difficult to find a market for other people to buy a lot of these bonds. So the Federal Reserve bought a lot of mortgage-backed securities and a lot of derivative instruments, and continued to buy government bonds at an extremely enormous rate. So the Federal Reserve's balance sheet is much expanded in just that 2-year period, and that's one of the advantages or strengths of monetary policy is how much the Federal Reserve can impact the economy by taking these actions. So there's 4 tools of monetary policy. The first one we're going to go over in more detail in the next slide or two. It's called open market operations, and that refers to the buying and selling of government bonds by the Federal Reserve. So that's open market operations. The next 2 are actually things we've already discussed. Right? The reserve ratio. So it hasn't been since 1992. That was the last time the reserve ratio was altered. It was lowered from 12% to 10%. But remember, that reserve ratio has the double impact. If the Fed were to lower the required reserve, right? Number one, it immediately impacts the amount of excess reserves that banks hold, but also impacts or directly influences the size of the money multiplier. So the reserve ratio is the most powerful tool of monetary policy, but it's also the least frequently used tool of monetary policy. The third tool, the discount rate. Right? Remember, the Federal Reserve is the lender of last resort. So our nation's central bank, the lender of last resort. When banks or financial institutions are in need of funds and they can't get another bank to lend them the funds, then banks can turn to the Federal Reserve to borrow money. Right? And that's when the Fed loans money to banks, they do so at the discount rate. Term auction facility is newer, like a new twist on monetary policy from 2007 to December of 2007. Right, so twice a month, banks actually can bid on the right to purchase reserves. Right, and there's a little more detail on another slide about this, but it's worth mentioning here. This has been a highly successful program introduced by the Fed since 2007, most because of the anonymity that banks can remain anonymous about the bidding for reserves. So here's how open market operations works. Right, so the buying and selling of government bonds by the Fed. Right, so we're going to see that if the economy is in a recession, the Federal Reserve would want to buy bonds, and how that's going to affect the money supply. And if inflation is plaguing the economy, the Federal Reserve would want to sell bonds. Right? So who are they buying and selling bonds from? Well, commercial banks and the public is who the Federal Reserve operates when we talk about open market operations, right? So it's highly effective at influencing the supply of money, and it has a quite immediate impact on the amount of money in circulation. So open market operations is the most widely utilized tool of the Federal Reserve, right? So again, if the Fed buys bonds from banks or from the public, right, reserves are increased. Right? We're going to see the cause and effect relationship here. Just think of Bank A, right? If Bank A has $10 million worth of government bonds, you say, well, why, first of all, why would a bank own government bonds? Banks own bonds because they're a secure investment, and they're also required by law to have a certain portfolio of safe investments. So when the Federal Reserve comes in and buys bonds from a bank, immediately that cash that the bank received can be loaned out. It represents excess reserves that can potentially be made into new loans, which obviously, the process we covered in the last chapter, where this will increase the money supply. If, on the other hand, when the Fed sells securities to commercial banks, reserves are reduced, and again, this would be proper monetary policy if the economy was experiencing inflation. I like this particular side because it displays in a nice little picture how open market operations work, and as far as how the money supply is affected by the buying of bonds by the Federal Reserve. So assume that the Federal Reserve buys $1,000 worth of bonds from a commercial bank. All right, so now that commercial bank is in a position to lend out $1,000, right? Which means the entire banking system, assuming that the same two assumptions we had before when we covered this process, that number one, banks lend out all of their excess reserves, and number two, that all new loans are immediately redeposited into another bank, and therefore there's no leakage out of the system, right? Now, I don't know why McConnell does this, but they always use 20% as the required reserve in these examples. So in this particular example, if the Fed buys a $1,000 bond from a commercial bank, that first bank is in a position to lend out $1,000 and therefore create $1,000 worth of new monies. And then the entire banking system can create $5,000 through the money multiplier. Now that's assuming a money multiplier of 5, because 1 divided by 0.2, if the reserve requirement was 20%, they need to have a money multiplier of 5, and 5 times 1,000 is 5,000. That's where they're getting this number. Just remember, in the real world, the actual reserve requirement is 10%. So if tomorrow the Federal Reserve bought $1,000 worth of bonds from a commercial bank, that bank can lend out the entire $1,000, and therefore the entire banking system could create 10 times 1,000 or $10,000. Now, the most important aspect to this slide is the idea that when the Fed buys bonds directly from a commercial bank, this is more expansionary than when they buy from the public, and we're going to see why here on the next slide. So if the Federal Reserve buys $1,000 bonds from the public, right, and then that money is deposited into a bank, right? Remember, banks must hold part of that as reserve requirements. So it's less expansionary when the Federal Reserve buys bonds from the public than when they buy bonds directly from commercial banks. Again, in this example, McConnell has the 20% reserve requirement. So if $1,000 worth of bonds bought from the public, right, and assuming that the public now deposits that into a commercial bank, 800 of it represents excess reserves, and therefore potential new monies that can be created, new loans that can be created, right? And 200 of it would be required reserves, right? So 8 times 5, right? 800 times 5, that gets you to your 4,000 that the total banking system could create. Right? So that's your number down bottom there. So again, most important idea associated with this slide is the idea that when the Fed buys bonds from the public, it's expansionary, but it's not quite as expansionary as if they bought bonds from commercial banks. All right, so real quick review here. Right, the tools of monetary policy, open market operations was the buying and selling of bonds. The reserve ratio, which remember does change the size of the money multiplier. Right, the discount rate, and the Fed is the lender of last resort. Right, creating short-term loans for banks who are short on required reserves. And then this term auction facility, right, again introduced in December of 2007, and it gives banks the opportunity to bid to borrow reserves from the Fed, and it's been highly effective mostly because it directly impacts the amount of excess reserves that banks are holding, and because of the anonymity that banks can remain anonymous about their purchases of these reserves. So in a previous slide, we talked about the different interest rates. One of the most important interest rates is the federal funds rate here, right? So it's the rate that charged by banks on overnight loans. So in other words, if Bank of America has excess reserves and Wachovia is short on required reserves, Bank of America can lend funds to Wachovia in the federal funds market, right? And that's the interest rate that Bank of America would receive for lending the funds to the other bank, to Wachovia. So the Federal Reserve sets the Fed funds rate, and what they do is called targeting the Fed funds rate, right? So right now the Fed funds rate is extremely low. It's at 0.25%, right? And it's because our Federal Reserve, our nation's central bank, has been conducting monetary policy in correspondence to the severe recession that has plagued the U.S. economy since 2007. So the Fed desires to have extremely low interest rates, and the way the Fed accomplishes the Fed funds rate, or gets it to the interest rate in which they desire, is the Fed conducts open market operations until the Fed achieves the desired Fed funds rate. This is a good slide. This slide, the next slide, it shows you the relationship between some of the interest rates in the economy, right? So the most important ones here is, identify the Fed funds rate, which is and the prime rate. If you look at the relationship between those two interest rates, right, this is from about the end of the year in 1996 all the way up through 2005. Right, you can see that they're almost mirror images of one another. The two interest rates down bottom there. That when our nation's central bank alters the Fed funds rate, it definitely has an impact on the prime rate. And the prime rate's extremely important because that's the rate at which banks lend money to their most credit-worthy customers. Right. This in similar slide says, okay, does the Fed funds rate affect mortgage rates? And you have the Fed funds rate is the red line on this curve, right? And the 30-year mortgage rate is the blue curve. So there's not quite as much similarity between those two interest rates as there is between the Fed funds rate and the prime rate, right? And the reason is because mortgages are typically long term. So when you go out 15, 20, 30 years, so the Federal Reserve does impact mortgage rates, but they don't mirror the Fed funds rate. The 30-year mortgage doesn't mirror the Fed funds rate as closely as the prime rate does. All right, so let's talk about how monetary policy works exactly. Let's assume for a moment that the economy is in a recession, as pictured here using the tools of aggregate supply and aggregate demand. So you can see here that aggregate demand has shifted left quite significantly, which means that the economy is in a significant or severe recession. All right, so GDP is negative, unemployment is high, and there's very little, if any, inflation. So inflation of 1.5%. Right. So the question is, what can the Federal Reserve do? What tools are at their disposal to kickstart the economy, to try and improve economic outlook for the U.S.? Now remember, the Fed controls interest rates by affecting the money supply. And we just went over the four tools the Fed has the reserve ratio, the discount rate, open market operations, and this term auction facility. Right? All of those could be aimed at increasing the money supply to bring down interest rates. And remember that certain types of spending, specifically consumer spending on big ticket items, cars and homes, and investment spending by businesses on new equipment and machinery and tools, is highly influenced by the interest rate in the economy, right? So here's the way expansionary policy works, the cause and the chain effect. So just like we said on the previous slide, if the economy is in a recession, right, unemployment is the problem. So how can the Fed use the tools of monetary policy to kickstart economic activity? All right, so if the economy is in a recession, the proper monetary policy would be referred to as expansionary monetary policy. All right, so in this case, the Fed could buy bonds, right? So let's think about how this would work. Right? The Fed buys bonds, right? Banks receive cash for selling their bonds to the Fed, right? That cash represents new reserves for banks, which means banks are in a position to lend out money, which would increase the money supply, which would bring down interest rates. Right? The Fed could lower the reserve requirement, right? And lowering that reserve ratio would directly increase the size of the money multiplier and the amount of excess reserves that banks hold. Right? The Fed could lower the discount rate, or they can increase the amount of reserve auctions to allow more banks to bid for excess reserves. Right? All of these are going to have the same exact impact. If the Fed buys bonds, lowered the reserve ratio, lowered the discount rate, or increased reserve auctions, they would all increase the amount of excess reserves that banks hold. Right? This brings down the Fed funds rate, which in turn increases the supply of money. Right? Supply of money increases, which brings down interest rates. Right? So we just looked at that relationship between the Fed funds rate and the prime rate. So we know that if the Fed can bring down the Fed funds rate, like that's going to bring down the prime rate, and that's going to stimulate economic activity. Right? So we covered in detail on that chapter about Keynesian economics the idea that there's a relationship between the amount of gross business investment that takes place and the real rate of interest. We know that businesses constantly weigh the expected rate of return versus the real rate of interest. So at much lower interest rates, there are significantly more projects where the expected rate of return would be greater than the real rate of interest, right? So then finally, investment spending increasing shifts aggregate demand to the right, and then the increase in aggregate demand, of course, increases real GDP. Right? This is a good slide here because it shows us piece by piece exactly what we were just talking about in the previous slide. Right? So you have your money market up top on the left. Right? Now I know you look at this and say, wow, 10% interest rate, right? Well, don't worry about the numbers as much as the economic lessons associated with this slide. So assume we have an interest rate of 10% given the supply of money and demand for money. Right? That can be the Fed funds rate. Right? Notice down bottom that the economy is in a severe recession. Aggregate demand has shifted well left. Right? So the Fed understands that expansionary monetary policy is needed to help jumpstart the economy. Right? So the Fed can lower the reserve ratio, or lower the discount rate, buy bonds, or increase the amount of term auctions available for purchase by banks. And all four of those monetary policies will have the same impact. They will increase the money supply. And notice that as the money supply increases, it brings down interest rates, and then the relationship between the interest rate and the amount of gross business investment that takes place. So there are more projects which will be profitable at a lower interest rate. So increase in the money supply brings down interest rates. Lower interest rates in turn increases investment spending. And then of course investment spending shifts aggregate demand to the right. Right? Now, one of the criticisms of monetary policy is that interest rates can be extremely low and there still might be very little incentives for businesses to spend on new equipment and machinery. That's one of the major drawbacks of the current monetary policy is that the Fed has been very accommodating. However, businesses have been reluctant to borrow and invest just because the outlook for economic activity has not been positive. Okay, what if the problem is not a recession? What if we are experiencing inflation, demand pull inflation? Well, at this point, the Fed would want to actually slow down economic activity because remember, demand pull inflation is too much money chasing too few goods, right? Too much money chasing too few goods. So, as pictured currently on this slide, using aggregate demand and aggregate supply to explain macroeconomic equilibrium, aggregate demand is excessive here. Spending is excessive. So consumer spending, business spending, right? So the question is, what's proper monetary policy if the economy is experiencing demand pull inflation? In this case, we would expect the Fed to use what's called restrictive monetary policy, right? So it's the same for tools, but in this case, just in reverse. So if the problem is inflation, right, the Fed's going to sell bonds to banks, right? So if you think about it, the Fed gets the money, and the, the the banks get bonds. Now remember, banks cannot use bonds to create new loans. They can't use them as collateral, so to speak, to create loans. So when the Fed sells bonds to banks, they reduce the amount of excess reserves that banks are holding, and therefore that's going to reduce the money supply. Right? The Fed could increase the reserve ratio, they could increase the discount rate, or they could decrease the amount of reserve auctions available. Right? All four of these actions would have the same effect on reserves. There would actually be a decrease in excess reserves, which would then in turn bring up the Fed funds rate. So here the Fed funds rate rises. So a higher Fed funds rate means that the money supply falls. If the money supply shrinks a bit, then interest rates are going to increase. And at higher interest rates, there's going to be less investment spending, and therefore aggregate demand will decrease. And if this all works well, inflation will come down a bit. So let's again look at this graphically. Right. So if we bring up, we see up top here that at SM1 the interest rate is 8%, right? But if the Fed sells bonds, increases the discount rate, increases the reserve ratio, or decreases the amount of term auctions available, all of these are going to decrease the amount of excess reserves that banks hold, which in turn will shrink the money supply. Right? At a lower money supply, lower supply of money, right, decreasing the supply of money pushes up interest rates, which means investment spending would actually drop. Here, investment spending drops, and then hopefully that will shift aggregate demand to the left, and that will have a positive impact on the amount of inflation because slower spending should bring down price levels. Now, what are the advantages and disadvantages of monetary policy? The first advantage is speed and flexibility, right? The Fed can utilize open market operations on a daily basis, right? The Fed can also buy large or small quantities of bonds or sell large or small quantities of bonds. So open market operations is extremely flexible in the amount which takes place and is also quite speedy. So if you think back to some of the financial crises that or geopolitical crises that the Fed has guided us through. In 1987, the stock market had a significant crash, right? And without getting too technical, there were banks who were worried that some of their customers were not going to be able to make their margin calls. So the Federal Reserve actually lowered the discount rate by 50 basis points in one day to ensure banks that if they needed the cash, the money would be there, right? Again in 2001 with the September 11 attacks, right? Because of the shock of those attacks and the impact on obviously the financial district, but also just the country in general. The Fed acted quickly again, reducing the discount rate and the Fed funds rate by 50 basis points, within days after those attacks. So that's one of the primary advantages of monetary policy is its speed and flexibility. The next one is also important is it's isolated from political pressure. Remember that the 7 members of the Board of Governors are not up for election. Right? They are chosen by the President and appointed by Congress, but once they are in their positions, they're there for the duration of their term, and they don't get elected by the public. So the Fed can make difficult decisions even if they're not popular. So, for instance, in the 70s when the economy is experiencing very high inflation, Paul Volcker actually decided to increase interest rates, right? Decrease the money supply, increase interest rates, because he believed that even though inflation was at 12, 13, 14%, that we needed higher interest rates because this would bring down spending, which in turn would stifle inflation. It took about 18 months, but inflation dropped from a high of 17% in 78-ish, and then all the way down to under double digits in the early 80s. So speed and flexibility and isolation from political process pressure. Right. Recent monetary policy, I sort of just talked about some of the 2001 with September 11 attacks, but I think we're going to look back on history and say that the Fed should really be rewarded with guiding us through one of the most difficult periods of in recent U.S. economic history. Unfortunately, the Fed didn't make such good decisions during the Great Depression, right, at a time when money was tight and loans were difficult to get. The Fed actually decreased the money supply, right? But in looking back, it's difficult to criticize the Fed because they had only been in existence since 1913, and at the time of the Great Depression, no one really understood macroeconomic thinking like they do now. Right? But I think that the Federal Reserve will definitely be, I would say, considered spectacular management of the financial and economic disaster that plagued not only the U.S. economy but the global economy since 2007. Right? Now there are some problems with monetary policy. Right? One is just like when we talked about fiscal policy, it takes a while for anyone to recognize what's truly going on with such a large economy, so that could take some time. Right? And then just because interest rates are lower, it might take a little bit of time for the investment to actually kick into the economy, so some operational lag. But this last criticism is something I was referring to earlier, cyclical asymmetry, which means this. You can lead a horse to water, but you can't make him drink. If the economy is experiencing any type of inflation, the Federal Reserve can reduce the money supply, shrink up the money supply, and soak a whole bunch of excess reserves out of the system, which will stifle spending. So the Fed is very good at reducing inflation because they can, think about a spigot, they can really shut the spigots down to a trickle if need be. However, when there's a severe recession as the one we're experiencing today, it's nearly impossible to convince businesses to borrow and invest. So even though interest rates are extremely low, lowest in 50 years, it's the Fed cannot force private businesses to borrow and invest in new projects or buy new equipment or increase factory space size or buy new tools. This only takes place if those private businesses believe it's worth their time and energy to go ahead and invest in new equipment.